Hey everyone, welcome in to another daily editorial here on the KE Report, a special daily editorial again as we are chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market website, which I will link to in the show notes. Mark, let's recap Friday's jobs data. We saw reported job gain of 142,000. That was about 23,000 below expectations. And potentially, even more importantly, the prior 2 months were revised down by a total of 86,000 jobs. So, really, here, the jobs number not that great and continues to show a general decline or slowdown in the jobs market. Mark, dive into that number. Anything stand out to you?
I would say that the jobs market, I think there's no debate about it, that the jobs market in the US is slowing down. And the question really becomes the pace of it. And today's data, I think many of us went into today's jobs data hoping for something that was going to be resolving this debate that the market is having with itself, whether the Fed cuts 25 or 50 basis points. But the jobs data was mixed. When you look at it closely, you say, okay, fine. To your point, we did gain 142,000 jobs, but given the consistency and magnitude of downward revisions, we have to sort of look at that number with a little bit suspect. On the other hand, the unemployment rate fell for the first time in 5 months. The unemployment rate fell from 4.3% to 4.2%. Not a lot, but it's really the direction here that counts. Average hourly earnings, that's the pay, that's went up 0.4%, a bit more than people expected, more than the economists projected, and the year-over-year rate ticks up to 3.8% from 3.6%. This is above what we're going to find out next week is the U.S. inflation level. And then what also points to still a relatively firm economy is the average weekly hours picked up. And again, it's not a lot. It's 6 minutes over the course of a week. But when you have hundreds of millions of people working, it turns out to be material in terms of output. So bottom line here, jobs data, again, people are going to say it's soft. Labor market is softening, but there were pockets of resilience there. And it doesn't seem to me to be the kind of data that says the economy is falling off the cliff, and Federal Reserve needs to be very urgent about cutting interest rates aggressively to avoid a further slide.
Well, Mark, just as far as the job revision part of it, we've seen that trend really for almost a year and a half now, and most of the revisions have been lower. It's not like they were a lot up and a lot down in a mixed bag. The majority have been less jobs were actually there than noted on the headline numbers. So if you'd come out today and said there was only 100,000 jobs instead of 142,000, I think there'd be a bigger market reaction. But the tendency is to put out a number and then revise it down, like the last 2 months, down 86,000 jobs. So do you think that that's just gamesmanship, or you were mentioning off mic that you kind of handicapped this a little bit on your own? How should the markets even react to these jobs numbers?
Well, I think that's what a lot of us do is we look at the revision. I'd say a couple of things about the revisions. One is that I usually think about the direction of the revisions, especially a sustained pattern, like you point out, Chad. I usually think of that as really the underlying direction. So in a weakening jobs market, you'd expect to see downward revisions. Like in a market where you have strong jobs growth, you'd expect the revisions to be on the upside. I think that's just a general like rule of thumb when it comes to revisions. Secondly, I don't think the revisions reflect some kind of deep state or some kind of purposeful glossing over things or trying to mask the underlying truth. I think that it really has to do with the methodology and how the unemployment data is collected, how we can verify it. So the trade-off is to get quick access. I mean, August ended less than a week ago, and somehow we expect the Bureau of Labor Statistics to have an estimate on an economy, the world's largest economy, within a week. How many jobs? So they make a quick estimate and they make that estimate on two surveys, household survey and an establishment survey. But then to get to what's really going on beyond just the surveys is you begin getting data from the states, number of people collecting unemployment benefits, payroll withholding taxes. And these kind of things can help support or like lend credibility to an estimate or help you fine tune an estimate. We also have the problem, a couple of other problems that like measuring type problems. Besides that corporations seem to be less willing to participate in a non-farm payroll survey, you have a couple of other challenges. One is that it looks like part of what's going on is there's people who are trying to return to the labor market. Maybe they retired early, maybe for taking care of family or something. They left the labor market and now trying to come back. So that increases the participation rate without necessarily increasing the jobs. Because those people didn't have jobs, but are just beginning to look for jobs, they don't get unemployment benefits. So it might not show up in the state data. The other thing that's happening, of course, that other people have highlighted is the role of immigrants and how the immigrants are treated and how they can be caught up in the data, leading to conflicting signals. So bottom line here is I think that yes, labor market's slowing, and because of that, we should take a look at this 142,000 and handicap it, cut it a little bit. Even if you cut it at 42,000, give us around 100,000. Yes, labor market softening. We are still creating jobs. Again, the unemployment rate fell. But I think that we do have a problem with the data. But again, I don't think the data, I think it's more methodological. And I think if you go back, you'll find that the BLS, for example, always has these annual revisions that took place a couple of weeks ago. It's not really new. I think it's just the market has become more sensitive to it for various reasons. Part of it might be political, especially, this is the fourth year of the presidential cycle. We have an election coming up. People might suspect government's trying to massage the data. But then why would they allow the revisions?
Mark, let's move on from that and talk about what really matters here and what everyone carries it over to. And that's what the Fed is going to do. Look, we all, I think, know we're getting a rate cut coming up in a matter of a week and a half. But is it going to be 25 basis points? Is it going to be 50 basis points? Is it even going to be more than that? It doesn't look like it. But how does this data play into what the Fed is going to do?
Yeah, I think you're right. I think that's the million-dollar question here. And when the dust settles everything today, the market probably has reduced the chances of a 50 basis point cut. This morning, before the data came out, it was a little bit above 40%. It went a little bit above 50%, but we're finishing the day here, so it's late in the session, at about a 25% chance of a 50 basis point move. And this follows comments from, you've had a few Federal Reserve officials speak today, and it seemed to me that the takeaway message from them is that the base case is 25 basis points for this first move, and that they would feel, if needed, they're open to an accelerated pace, which implies that 50 basis points. But the market still is priced in. So we talked about what's priced in for that September 18th meeting. But when you look at what the market's pricing in for by the end of the year, it has roughly 112 basis points of cuts priced in. So how do you get to that 112? I think that implies the market still, like the pricing is still consistent with about a 50% chance that we not only get the 50 basis points in one of the two meetings, we can get them in both meetings. And that's what the odds that are being priced in suggest. We get 25 basis points, most likely September, 50 basis points probably in November, and the market is saying there's a 50% chance of another 50 basis point cut. I think that's a bit rich here to have two 50 basis point cuts. I'm watching for the Atlanta Fed, and they will update their GDP tracker. Now that we're well through the bulk of Q3, their tracker should become a little bit more accurate. Its last iteration was 2.1%. That 2.1% is important to me because it's above what the Federal Reserve regards as trend growth. That level of growth to the U.S. economy that's not inflationary. So from the Fed's point of view, then, yes, the labor market's slowing. It did continue to slow. It didn't slow as bad as it did last month in July, but the labor market is slowing. Fed, I think it's very clear the Fed will begin a series of rate cuts. And I think that's what's being priced in.
Well, speaking of pricing things in, let's also look at the 10-year and the 2-year Treasury yields, because we have something significant happening here on Friday as we discuss this, where it looks like for the first time in maybe 18 months, that you still have the yield curve finally uninverting. Like after being inverted, the 2-year is finally lower than the 10-year, and we're seeing some interesting things in the interest rates. What do you make of that market?
Yeah, no, I think you're right. We're watching this. It's probably interesting for people watching how the market's closed, because we've had these intraday reversion or disinversion of the U.S. yield curve. We haven't done it on a closing basis, but it looks like we're going to today. Like you say, it's the first time in quite a while. In fact, probably the first time since middle of 2022 that we'll get a positively sloped yield curve. Something to keep an eye on, maybe 10 basis points positive is the 200-week moving average, just to put that in perspective for you. That's roughly 4 years, and that's the average. But, I think we might have talked about this before too. The challenge had been many people thought that the inversion of the curve is a sign of a recession. And here we are, like you say, 2 years of having an inverted curve, no recession. So what's the story? I think that when you really look at the data closely, it looks more like the recession takes place after the curve goes back to, so it's inverted and it comes back to a normal slope. That is typically more of when the recessions begin. Different economic participants have to respond to this sharp change in interest rates. Remember that back last year, middle of last year, the curve was inverted by more than 100 basis points. So it's been quite a large move. And I think partly what's happening is the market is doing some of the Fed's easing for it. You talk about where the 2-year is. We're at about 365 yield on the U.S. 2-year. It peaked in April just about 5%. So imagine that the Federal Reserve hasn't begun easing yet. The market anticipates the Fed easing and reduced 2-year U.S. Treasury by 150 basis points.
So, Mark, what matters moving forward here then, either market-wise, data-wise, before we get to that Fed meeting? What's going to move markets?
Well, I think what everybody's going to be watching now is next week's CPI number. Actually, two things next week. The CPI comes out on September 11th. The market is looking for a 0.2% increase, headline in core. Given what happened last year, a 0.2% increase will allow the year-over-year rate to drop. So we should be expecting a soft inflation number. What's interesting is the night before the CPI number is when we have the first debate between Harris and Trump. And that's, of course, important because everybody remembers the last debate and how momentous that was. So this is going to be a big deal, September 10th and 11th. And of course, the other big event next week is the ECB meeting. And there, the ECB, there's little doubt, but the ECB is going to cut interest rates on September 12th. That'll be their second cut, 25 basis points discounted. The issue is how much more do they cut? And the market's got another 25 basis point cut in the Q4. And maybe, I should say that after next week's meeting, there's 2 meetings left. The market has 25 basis points, but maybe even another 25. It's leaning. We've had some horrible numbers from Europe this week. It's really you really think about why the euro is even at these levels. We peaked last month just above 112, and after the jobs data, we traded 111.55 on the euro. It's held up incredibly well, even though what's going on doesn't seem to be positive coming from Europe. I'll give you an example there. Yesterday, Germany reported an increase in industrial in factory orders. People got excited about it, and today they reported July industrial production. The market thought it might fall 0.5%. Instead, it fell 2.4%. German industrial output is down 5.3% year over year. Yet the euro has remained relatively strong at the upper end of where it's been this year. And I think that what's going on, I think, in the foreign exchange market is really reflected a dollar weakness in the last few days as the market turned very negative, the dollar, very bullish on the Fed cutting interest rates aggressively, and running into this bit of a wall here today with the jobs data.
All right, Mark. Always great chatting with you. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which the link will be posted in the show notes. Thanks for breaking down what was probably the most important data point from this week, the jobs number, and even more importantly, what we should be focusing on market-wise. Mark, thank you again for your time. We'll try to chat with you again next week.
Thanks. Good luck to everybody.